Very good afternoon. You're watching the newsroom right here on ET Now. I'm Ajay Sharma. The markets are trading under pressure, bit of a pressure, some unwinding of positions. Dollar index actually globally has rebounded after falling to almost 106. That seemed to be causing some pressure. Markets are back to their support levels. Let's see whether they hold on to it or go down. But there was a general view in the market that the rally has lasted and we are almost at all-time highs. So some pullbacks will only make the market healthier. We've got Vinod Karki, who is joining us today to talk about his own investment approach in this market. Vinod, afternoon. Vinod, first of all, before I come to your note, just wanted to get your thoughts on the way global macros have eased. Crude coming down, US 10-year coming down, and dollar index coming down. All of them actually support India macros a lot and hence actually positive for the markets. What are your thoughts there?
Yeah, so that's very important, Ajay, because if you observe last year, calendar year 21, we were preparing by the end of that year, going into a quantitative tightening cycle. And what hit us, the double whammy was the Ukraine-Russia conflict, which really, set the whole thing on fire. Inflation expectation, people started talking about that it would be like the 60s, 80s, where Paul Walker had to raise interest rates to as high as double digit in the US. So that story is slowly fading out, and now people are even talking that the inflation has peaked out, and things will be much better on that front, which is reflecting in bond yields and the expectation of a end of the quantitative tightening cycle. So that is very important from an equity perspective, because equity valuation contraction in over the last several months was primarily being driven by this fact that we are into an unprecedented quantitative tightening cycle, which typically results in equity valuations getting severely contracted. So I think that is receding, and which will set a floor for equity valuations in my view. So equity valuations will not contract significantly from here if we are peaking out in terms of the quantitative tightening cycle. What it has also done is that you just think of this case that last year when the US Fed was at around 0.25% Fed rate, and if that they had maintained those rates and we were going into a recession, they did not have any ammunition left to fire going into a recession. Now think of this, currently, going by the current terminal rate, we end up around 4.5 to 5, anywhere between that in the next several months. That gives the Fed some ammunition, or rather quite a bit of ammunition to support a recessionary kind of environment whenever we reach that kind of environment. Although there is nothing to suggest right now that US, going by high frequency data on jobs or retail spending and all, it is not suggesting that immediately there is any recession. But even if we go into recession, we have something from the Fed to intervene and take rates lower, basically. So I think from an equity perspective, that is reflecting into that this quantitative tightening cycle, which was being extrapolated, that's receding, which is showing up into flows into emerging markets like India and other places, which are risk assets globally. So that's the big picture in my view, from a global macro and equity valuation perspective.
Right. In fact, I was just analyzing the flows which have come in. FIs have become buyers, almost 30,000 crore in November till date, and 40% of those flows have actually gone into financials. And surprisingly, the second biggest area after financials where incremental FI flows are going in FMCG and IT. How do you see this point? Because margin pressures and growth slowdowns were issues both these sectors were hit by. Do you think peak of pessimism already in margins here in FMCG for that matter?
Yeah, so latest research, just prior to the one we released yesterday, we had pointed out that in the economy, it's largely a zero-sum game in terms of margin transfers or profit pool transfers. So last year, a few months ago, when commodity prices were spiking, the argument was that commodity producers are getting the benefit of the profit pool shifting from the commodity users, basically, because they are getting windfall profits. Now what is happening is, if you see any of these commodity producers, their profit pool has significantly shrunk because commodity prices have come down significantly. So it is but natural that on an aggregate basis, the commodity users will see the benefit, and we are seeing the initial signs in terms of commentary, because these contracts don't change overnight. It takes some time, but we can see that commodity prices have come off, and if commodity producers profit pools are reducing significantly, it is a matter of time that commodity users will gain at the benefit of the commodity producers. So that margin, they have a lot of these companies have taken some amount of price, rise, and they won't be in a hurry to cut if the demand is robust. And we're seeing that the demand in general is reasonable, if not spectacular. So in an environment where demand is robust and input cost prices go down, I don't see any reason why margins should not, at least sustain at the current levels, if not rise. Yeah, so that's the broader outlook. Obviously, certain sectors will benefit or lose, but broadly, this seems to be the trend that margins pressure should start to ease going forward.
Right. Vinod, you're bullish on the capex cycle. One of the capex cycle part is CVs. We saw Ashok Leyland commentary seem to be suggesting they are gaining market share. Today, Escorts Kubota also commentary is something which the market lies. How do you see the CV part of the capex cycle in India?
Yeah, absolutely, you're right. CV is another capital goods. So the direct beneficiary of a capex cycle revival is capital goods, and it takes some amount of lag in terms of which capital goods see the first effects. So certain sectors like CVs and also might show it early, but other larger turnkey capital goods producers will also see the benefits as and when the large greenfield, large brownfield projects start taking off. So, but the main point is that capital goods, including CVs, will be a direct beneficiary of a capex cycle, and typically capex cycle, they take time to start. You have just seen the start of the whole capex cycle in terms of announcements and some movement we are seeing. But these cycles don't fizzle out in a year or so. They build on the momentum, and it at least lasts for several years. So I think it's a very good environment for capital goods and capital intensive sectors in terms of demand out. There is no question on that front.
Right. Before I let you go, there's a kind of a dilemma in the market, on engineering and capital goods, that the universe, good quality companies are not trading cheap. They are quite expensive, and people are kind of scared going into the lower quality plays as far as engineering and capital goods are concerned. How are you navigating this issue?
Yeah, so thankfully, what is happening is some of the, if you see the largest engineering company, L&T, so I don't think it is at any valuation which can be thought of as euphoric or anything like that. So, although it's not extremely cheap, and some of the other engineering companies, as you rightly pointed out, which are quality companies, are not anyways cheap. But you have to remember that it's where is the demand coming in the economy. Valuation call is very difficult, because what we have observed that wherever there is a boom in terms of economic activity in whichever sectors, valuation takes a back seat. It's the numbers, and this the order book keeps flowing in, the earnings keep expanding. It's very difficult to take a valuation call. You will find languishing valuation only in sectors where there is no the outlook is not good. You know, but if and as I said, a capex cycle doesn't fizzle out in year 1 or 2. Basically, it takes several years. So, there will be several legs to their performance. So, some of these companies may have outrun in the first leg. But the point is, if year by year the demand keeps coming in, how will these stocks correct? Basically, every quarter you will see better and better order books, surprises on earnings. So, things only get expensive, and that has been the problem with capital markets at any sector. Look at internet companies last year. They didn't have even earnings basically, but the outlook was looking great. So people kept bidding up the prices. So, so that's the thing. You have to look at where the demand is coming, and, so things will keep getting expensive there basically. You have to only be there in the early part of the cycles to ride out the entire cycle. That is what It's very difficult to take valuation calls in areas where the growth is looking robust. That's a dilemma. You put it rightly. It is a dilemma.
I understand. Fair point. Fair point, Vinod. Always great chatting. Thanks so much for your time. Before we take a break, here are what Manish Ray Chaudhary of BNP Paribas, who is stopping by in our studios today.